Options are a type of financial derivative that gives the buyer the right, but not the obligation, to buy or sell an underlying asset, like stocks, bonds, or commodities, at a specified price, known as the strike price, within a certain period. Options are widely used for hedging risk, generating income, or speculating on price movements. There are two main types of options: call options and put options. A call option gives the holder the right to buy the asset at the strike price, while a put option gives the holder the right to sell the asset at the strike price. Each option contract has an expiration date, after which it becomes invalid. Here's how options work. If you purchase a call option for a stock with a strike price of $50, and the stock's price rises to $60 before expiration, you can exercise the option to buy the stock at $50, earning a $10 profit per share. Alternatively, you could sell the option for its increased value without exercising it. Conversely, if the stock price remains below $50, you can let the option expire, losing only the premium you paid to purchase it. For put options, the reverse applies. If you buy a put option with a strike price of $50 and the stock price falls to $40, you can sell the stock at $50, earning a $10 profit per share. If the stock price remains above $50, the option expires worthless, and you lose the premium. Options are powerful because they provide leverage, allowing traders to control a larger position with a smaller upfront investment. For example, instead of buying 100 shares of a stock at $50, costing $5,000, you could buy a call option on those 100 shares for a premium of $200. If the stock price rises significantly, your percentage return on investment is much higher compared to buying the stock outright. Options are also used for hedging. For example, a farmer expecting a harvest of corn might buy put options to lock in a minimum selling price, protecting against a potential drop in corn prices. Similarly, an investor holding a stock can purchase put options as insurance against a decline in the stock's value. While options offer flexibility and the potential for high returns, they also carry risks. Buyers of options can lose their entire premium if the market doesn't move in their favor before expiration. Sellers or writers of options face even greater risk, as they may be obligated to buy or sell the asset at unfavorable prices, potentially resulting in unlimited losses for uncovered positions. Options are traded on exchanges like the Chicago Board Options Exchange, CBOE, or over-the-counter, OTC. Exchange-traded options are standardized and regulated, making them accessible and liquid, while OTC options are customized but less transparent and riskier.